Welcome back to Part B of Topic 13 lecture. Here we will discuss Learning Objectives 4 and 5. In Learning Objective 4, we will learn to journalize transactions and prepare the financial statements for private colleges and universities. So we are starting with the post-closing trial balance as of June 30th, 2019 for Valley College, a private college. During the year ended 30th of June 2020, the following were recorded. So first, we have the receivables, tuition and fees, $5,990,000, federal grants and contracts for $1,075,000, pledges without donor restrictions of $4,850,000, and with donor restrictions as to time and purpose for $1 million. Student scholarships in the amount of $450,000 were awarded, thereby reducing the amount of the tuition fees receivable to $5,540,000 and creating the contra revenue account, tuition and fees discount and allowances. The pledges receivable with donor restrictions will be collected over 5 succeeding fiscal years. Now, FASB standards require that pledges that will not be collected in less than a year's time to be reported at fair value. We've mentioned this too in topic 12. Now, Valley College has opted to use the present value technique to determine the fair value of the pledges receivable for years 2 through 5. So, we need to know the discount rate if we are to use the present value calculations. The discount rate selected is not stated here, but what they have told us is already the discount, so there's no need to calculate. The discount shown here is $74,000 on the pledges receivable. So the first journal entry to record the recognition of the receivables and the related revenue for fiscal year 2020 would be to debit tuition and fees receivable for $5,540,000, debit also grants receivable for $1,075,000, debit also pledges receivable $5,850,000, and the tuition and fees discount and allowances for $450,000. Our credit would be to tuition and fees without donor restrictions for the full amount of $5,990,000. So that includes both the tuition and fees receivable and the tuition and fees discount and allowances. The total of those two figures as given was $5,990,000. We will also credit the federal grants and contracts without donor restrictions, as well as contribution without donor restrictions for $4,850,000 and contributions with donor restrictions as to time and purpose for $926,000, and the discount on pledges receivable would be the $74,000 that we have been given. So the total of $926,000 and the discount of $74,000 is, as given before, $1 million. In addition to the recording of receivables, Valley College recorded the following cash collections. So they have collected for investment income without donor restrictions $700,000, with donor restrictions as to time and purpose $280,000, student deposits of $20,000 were also collected, and auxiliary enterprises cash collection amounted to $2,300,000. We will be entering this by debiting cash for the full amount. The total of this is $3.3 million, and we will be crediting investment income without donor restrictions for $700,000 investment income with donor restrictions, time and purpose for 280,000, deposits held in custody for others 20,000, and auxiliary enterprises without donor restrictions will be credited for 2,300,000. In the preceding year, unearned revenue was recorded for cash collected from students for classes offered in the current year. So we have collected last year some cash for the classes to be offered now in the current year. So in the current year, the unearned revenue amount of 350,000 will have to be reclassified as tuition and fees. And the journal entry would be to debit unearned revenue 350,000 and credit the revenue account tuition and fees without donor restrictions for 350,000. Let's move on to entry number 4. This records the collections of cash for tuition and fees receivable amounting to 5,650,000, grants receivable of 1,075,000, and 4,945,000 in pledges receivable. For those pledges collected from prior periods, 14,000 of the discount on pledges receivable was amortized and recorded as contributions without donor restrictions. So our journal entry 4A will debit cash for the total amount of all these figures: 5.65 million, 1,075,000, 4,945,000. So the total of those three figures is 11,670,000. And our credit would be to tuition and fees receivable for 5,650,000, grants receivable for 1,075,000, and pledges receivable for 4,945,000. The next set of entry pertains to the discount. So we'll debit discount on pledges receivable for 14,000, and our credit would be to contributions without donor restrictions for $14,000. Entry number 5 records the operating expenses incurred in accomplishing the goals of the college. So in addition, operating expenses for auxiliary enterprises are also recorded. So here we are debiting all the instruction expense, public service expense, academic support expense, student services expense, institutional support expense, and auxiliary enterprise expense. These are all given figures. And our credit would be to accounts payable as well as accrued liabilities for the given figures. All right, let's move on. It says that accounts payable and accrued liabilities were paid in the amounts of 4,003,500 and 9,133,900 respectively. Refunds of students' deposits amounted to $10,000. All right, we'll debit accounts payable for the given amount and also debit accrued liabilities for the given amount. We will also be now debiting deposits held in custody for others for the 10,000 refund of students' deposits, and our credit would be to cash for the total of all these figures, 13,147,400. Next, the inventories and prepaid expenses increased during the year in the amounts as shown in entry number 7 here. So also we are told that the inventory purchases and prepaid expenses were previously recorded as expenses. The increases in inventories and prepaid expenses reduced expenses in instruction and institutional support. In order for us to reduce expenses in instructional and institutional support, we will credit those expense accounts. So we'll credit instruction expense and institutional support expense for the given amount, and our debit would be to inventories and prepaid expenses, thereby recognizing short-term assets in the form of inventories and prepaid expenses. Because as is stated here, when we purchase the inventory, we recorded them as expense. And so now we are reducing the expense accounts. All right. Let's move on to the contributions restricted for research purposes received. The amount is given 1,109,000. So we have received cash, so we're debiting cash, and this is a restricted donation. So our credit would be to contributions with donor restrictions, time and purpose for the given amount. Expenses for the restricted research purposes described in entry number 8 were incurred during the period in the amount of 1,025,000. So our entry would be to debit research expense for 1,025,000, and we haven't paid cash for some, and so we will credit accrued liabilities for 10,000 as given here, and it looks like we have paid cash for 1,015,000 out of the 1,025,000. So we are crediting cash for 1,015,000. We will now have to transfer from net assets with donor restriction to net assets without donor restrictions. So to do that, we will debit net assets released from restrictions with donor restrictions, 1,025,000, and credit net assets released from restrictions without donor restrictions, 1,025,000. Entry 10 records the receipt of state grants that are restricted until used for student loans. Our debit would be to cash, and as given here is 208,000, and our credit would be to state grants and contracts with donor restrictions, time and purpose, 208,000. Now, loans were made to students during the year in the amount of 260,000, and other student loans were repaid in the amount of 95,000, with an additional amount of 7,000 received as interest revenue on these loans. And it says here there are no imposed stipulations on the interests earned. So our journal entry for that would be debit loans receivable for 260,000 and credit cash for 260,000. In 11B, we are debiting cash for 102,000, the total of 95,000 and 7,000, and our credit would be to loans receivable 95,000 and also credit interest income without donor restrictions for $7,000. During the year, cash of 500,000 for construction of a new lab building was received from a private foundation, and 8% term bonds maturing in 5 years were issued in the amount of $2 million. We will be debiting cash for the full amount, 2 million plus 500,000 is 2,500,000, and our credit would be to bonds payable for 2 million and credit contributions with donor restrictions, time and purpose for 500,000. Moving on, during the year, the new lab building was completed at a cost of $2 million. The equipment cost amounted to $350,000, and renovations to the old lab building totaled $250,000. However, none of the renovations met the criteria for capitalization. So it looks like the $250,000 renovation cost will not be capitalized. So our debit would be to buildings, $2 million for the new lab. Debit also the equipment for $350,000. These two are capitalized costs, whereas the $250,000 renovation of old buildings will just be debited to an expense account. Debit would be to research expense of $250,000 and credit cash for the total amount of $2.6 million. Journal entry 13B, again releases net assets with donor restrictions to net assets without donor restrictions. So we have that $500,000 that we have in earlier entry that is being released. So our journal entry would be debit net assets released from restrictions with donor restrictions 500,000 and credit net assets released from restrictions without donor restrictions for 500,000. Next, Valley College received permanent endowment gifts during the year in the amount of $2,423,000. So, in entry 14, we debit cash $2,423,000 and credit contributions with donor restrictions endowment for the same amount. Long-term investments were made using $2.4 million from the permanent fund. So our entry now would be to debit long-term investments $2.4 million and credit cash $2.4 million. Now, entry 16 records the interest and principal payments on outstanding bonds and notes. The interest is allocated to instruction function. So, journal entry would be to debit instruction expense for the given amount, $1.85 million. Debit also the bonds payable, because this is the principal payment, $500,000. And debit also notes payable, $50,000, and our credit is to cash for the total of $2.4 million. Near the end of the current fiscal year, the college collected tuition and fees in the amount of $350,000 for classes that will be held in the following fiscal year. So we are collecting in advance. The college recognizes an unearned revenue liability because the fees are related to educational programs conducted next year. So the journal entry would be to debit cash $350,000 and credit unearned revenue for $350,000. Let's now go to the adjusting entries. Now in entry 18, it records the accrual of instructional and public service expenses as at 30th of June 2020 in the amount as shown. We are debiting instruction expense and public service expense for the given figures, 51 and 21,000 respectively, and because we haven't paid it, we're just accruing it, we will be crediting liabilities. So accounts payable will be credited for $65,000 and accrued liabilities for $7,000. At the end of the year, a pre-audit review of the loans receivable and pledges receivable indicates that the balances in the allowance accounts are sufficient. However, the allowance for doubtful accounts related to tuition and fees is increased for expected write-offs in the amount of $2,000. Our adjusting entry for this would be to debit tuition and fees without donor restrictions and credit allowance for doubtful accounts for $2,000. As of June 30th, 2020, the fair value of long-term investments increased by $7,800 from the value reported in the college financial records. The gain is restricted for the permanent endowment. Therefore, our journal entry would be to debit the long-term investments for $7,800 and credit unrealized gain on investments with donor restrictions endowment for the same amount. Finally, the capital assets are depreciated. For simplicity, the total expense is charged to the instruction expense. And so our debit would be instruction expense, $300,000, and credit accumulated depreciation for $300,000. Now let's go to the closing entries. In the first closing entry, in 22A, what we are doing is we are debiting all the revenue accounts and we are crediting all the expense accounts. And the difference will have to be close to the net assets without donor restrictions. All right, so these are all our revenue accounts. All the expense, the functional expense accounts are as given here, are closed. Next, in closing entry 22B, we are closing all those contributions with donor restrictions, time and purpose to net assets with donor restrictions. All right. So our journal entry is to debit contributions with donor restrictions, time and purpose, state grants with donor restrictions, time and purpose, and investment income with donor restrictions, time and purpose for the given amounts. And we credit net assets with donor restrictions, time and purpose for the total. In 22C, we are debiting contributions with donor restrictions endowment, debiting also the unrealized gain on investments with donor restrictions endowment, and our credit is to net assets with donor restrictions endowment for the total amount. Finally, net assets released from restrictions are closed. So we are debiting net assets with donor restrictions, time and purpose for 1,525,000. Debit also net assets released from restrictions without donor restrictions for the same amount. And our credit would be to net assets without donor restrictions as well as net assets released from restrictions with donor restrictions for the same amount. So once we've done the closing entries, we can then prepare the financial statements. And because Valley College is a private college, it will have the statement of financial position instead of the statement of net assets. It will have the operating statement in the form of statement of activities, and the statement of cash flows will also be provided. All right, what you can notice here is that in a private college such as Valley College, the statement of financial position, as you can see, will highlight the total assets, liabilities, and net assets, and the net assets are categorized as to without donor restrictions and with donor restrictions as to time and purpose. All right, total net assets would be given as well as total liabilities and net assets, which of course equals the total assets. In terms of the statement of activities, as in topic 12, because private colleges and universities will follow FASB standards, and therefore the presentation of their operating statement will have the 3-column format. The first column will be the without donor restrictions, and the second column with donor restrictions, and the third column will show the total. As shown here, the revenues and gains, both operating as well as non-operating, and the expenses and losses for both operating and non-operating are as shown here. And finally, the statement of cash flows, as you can see here, uses the indirect method. Valley College has cash flows from 3 types of activities: operating activities, investing activities, and financing activities. Let's now move to Learning Objective 5. Here we'll discuss the issues related to colleges and universities, such as the plan giving, measuring performance, auditing, and federal financial assistance. Let's start with plan giving, in particular endowments. We have learned in the past that endowments are donor-restricted resources that are non-expendable as of the date of reporting, and these can be invested for the purpose of producing income. There are generally 2 types of endowments: the permanent endowments or term endowments. Permanent endowments are gifts for which the donors or others have stated that the principal must be kept intact. Permanent endowments, from the point of view of private colleges and universities, will be net assets with donor restrictions. But from the point of view of public colleges and universities, this will be considered restricted, non-expendable net position. How about term endowments? Term endowments are gifts where donors have specified the principal must remain intact until an event occurs or until time passes. From the point of view of the private entity, colleges and universities, this is identified as restricted. From the point of view of public colleges and universities, these will be identified as restricted. So as you can see, it will be treated in the same manner. Let's move on to these, what we call split interest agreements. A split interest agreement occurs when a donor enters into an arrangement with the college or university requiring it to share the benefits received from the donor's gift with another beneficiary. So that's why we call it split interest. It is possible that the person donating will be the other beneficiary apart from the university. All right. So split interest agreements can either be revocable or irrevocable. So a revocable agreement will allow the donor to take back their gift in certain situations. And an irrevocable agreement is the opposite. It's one where the donor cannot take back their gifts to the institution. So it is possible that, all right, if I have this massive amount of money, let's just say $1 million, I am actually going to share it with the university. And so there will be an agreement that splits the interest between myself, I'm also part beneficiary, as well as the university as the other beneficiary. Now, if the institution has an interest in an irrevocable split interest agreement, the asset would be recorded at fair value. When the agreement includes promises to give non-cash assets like land or any real property, building, and the like, a present value or other fair value technique can be used, but still the asset will have to be recorded at fair value. Any liabilities accepted should also be recorded at the time of the agreement. So if I am, for example, bequeathing a building to the university, but the building still has some mortgage with it, and the university takes over the liability or the mortgage for that building, then the asset will have to be recorded at the time of the agreement as well as the liabilities. The difference between the assets and liabilities is either net assets with donor restriction or net assets without donor restriction, depending on the agreement between the donor and the university. So if a building that I own has a $50 million value and there is still owing of $20 million in it, and I am donating it to the university with split interest, all right? So at the point of the agreement, if our agreement states that you can't use this building for any other purpose apart from educational purposes, then that means this would be recognized at the difference between assets and liabilities is $50 million and there is a $20 million liability to it. There is a $30 million net difference between assets and liabilities, and there is a restriction to it. That it means this $30 million, the net difference between assets and liabilities, will be restricted because that the donor says it has to be restricted only for educational use. All right, let's look at other types of split interest agreements. There is this annuity agreement and pooled life income fund. In an annuity agreement, the assets are given to a college or university, and the institution periodically pays a fixed amount to the donors or other designated individuals for a period of time specified in the agreement, or for the lifetime of the donor or other designated individual. So, in the case of, say, the building that I have donated, there might be payments that I would expect, because whilst the university will have the use of the building, I will also want to receive, that's why it's called split interest, I would also like to receive some benefit from this asset that I have donated to the university. So whether it is land or whether it is cash that I am donating, it is possible to have this annuity where, for example, I will be receiving, let's just say, $1,000 every month until I die. So it is for the lifetime of the donor. So if I am receiving uniform amount of cash every period, then that is what we're referring to as annuity. All right. In a pooled life income fund, on the other hand, the donor's assets become part of a managed pool of investments called an income fund. So I could be donating, let's say, $20 million worth of securities, and it will be included as part of the managed pool of investments. And this is called income fund. Now, each donor is assigned a pro rata share of the income fund's units based on the proportionate fair value. We have discussed this in previous topics when we're talking about managed investment funds, right? The income will be actually shared pro rata, dependent on how much was that donated investment or securities provided. All right. So, based on the proportionate fair value, it's paid the total income earned on fund units held. So, it's only upon the donor's death the value of the assigned units will revert to the institution. So, there are quite a lot of cases where an alumnus of a university or a college will say, all right, whilst I'm still alive, I would like to be getting the income from the securities that I am bequeathing or donating to the college or universities. But when I die, then it will all go to the university. And that's what a pooled life income fund would be like. Let's now move to this Uniform Prudent Management of Institutional Funds Act. The UPMIFA of 2006 provides guidance for NFPs that manage funds for charitable purposes when there are no explicit donor stipulations. Two general principles are supported by this act. First, assets should be invested prudently in diversified investments that allow for growth as well as income. So, it is a requirement of this act that assets will not be invested in just high-risk type of investments, or it will just be invested in cash and marketable securities where the return is very low. Another general principle is that appreciation of investments may be prudently spent for the purpose of the endowment. Now, this act covers three main areas. The first stipulation under investments. It states that prudent investing in good faith is required. There must be a balanced investment decision so that you don't just put all your investments in high risk, high return investments. and there must be reasonable investment cost. So those are the three requirements under the area of investments. Let's look at the restrictions on net assets. The Act authorizes a modification that a court determines in accordance with the donor's probable wishes regarding the donation. So it is the court that determines what is in accordance with the donor's probable wishes. However, there is also another provision. Another provision allows a charity to modify a restriction on small and old fund without having to go to the court. So if a university has a small fund, less than $25,000, and a very old that is more than 20 years old, then they don't need to go to court. They can make some modifications. All right, let's now look at the expenditure criteria. The Act does not specify limitations on expenditure. However, there are 7 criteria that they have specified. The first one has to do with the duration and preservation of the endowment fund. Second has to do with the purposes of the institution and the endowment fund. Third, the general economic conditions. Number 4 is the effect of inflation or deflation. So inflation is prices going up and deflation, prices coming down. And the expected total return from income and the appreciation of investments is the 5th. 6th is having to do with other resources of the entity, the NFP, or the college and university. And last is the investment policy of the NFP. So for those universities that do not have huge amount of investment funds and all that, this is not such a big deal. But there are many universities that will actually find this act very useful. Let's look now at measuring performance. Just like any other entity that we have looked at, there is also a need to measure the performance of universities. We will be looking at Composite Financial Index, CFI, and the outputs versus the outcomes. In illustration 15-7, you are provided there with the calculation of the Composite Financial Index, CFI ratios. So the ratio names are provided: the primary reserve, net operating revenues, return on net assets, and the viability. So what are primary reserves? This ratio answers the question, do we have sufficient liquid resources to support the mission of the entity? And the calculation is provided there. Whilst the formula is quite long, what you really want to know here is liquid resources, the resources that you could use, those without donor restrictions and those that are not in property, plant, and equipment, and you are dividing that by the total expenses because you want to know whether you have enough liquid resources to pay for your expenses. In net operating revenues, what you are looking at is whether you have sufficient operating revenues to cover your operating costs. Return on net assets is similar to how we understand return on assets. We have the change in net assets divided by the total net assets, but at the beginning of the year, because this determines the strategic direction supported by our asset performance. In terms of viability, the question that it answers is our debt managed appropriately to ensure that we can deliver on our mission? So as you can see from the formula, we are again using the liquid resources, the resources that are not restricted, and dividing it by the plant-related debt. Now, the calculation of all these ratios for Valley College is shown in illustration 15-8. So whilst the ratio calculation is not that difficult, it is more the interpretation of it and looking at comparing it with a similar size and institution will be useful. Okay. The calculation for Valley College CFI is provided in illustration 15-9. Now we won't go into so much detail as to the calculations of the CFI, but suffice it to say that a score of 0.65 simply means that the college is in some kind of financial stress. All right. Now, apart from the CFI or the outputs as well as outcome measures or non-financial indicators are also important. In fact, in many cases, the student outcomes are more important in terms of getting funding or determining funding levels. Some states are requiring standardized norm-based objective exams, for example, although more often the institution is allowed to develop its own measure of outcomes based on the mission-based objectives. So the approach recognizes that the mission of higher education institutions differs in the weight each one places on instruction, research, and service. So there are universities that are providing service, efforts, and accomplishment report. Some examples of output measures might include things like graduation statistics, time to degree, that means how many years do the students take to graduate, the number of graduates, as well as job placements. What percentage of students got employment after graduation, 1 year after graduation, and the like. So those are examples of output measures. Outcomes measure the benefits derived by the constituents. For example, performance on nationally ranked exams or such outcomes as the student-employer satisfaction with the education quality of the students. Let's move on to other accounting issues, in particular auditing colleges and universities. Most colleges and universities, whether private or public, publish audited financial statements, usually on their websites. At a minimum, audits of colleges and universities are performed in conformity with the generally accepted auditing standards, GAAS, promulgated by the AICPA. Many colleges and universities, as a condition of accepting federal financial awards, are audited under the GAGAS, the generally accepted governmental auditing standards established by the U.S. Government Accountability Office, GAO, as published in the Government Auditing Standards, the GAS, which is also known as the Yellow Book. So, at a minimum, GAS should be used, but if the university or the college is accepting federal financial awards, then they might be required to use GAGAS. And specifically, if a college or university expends $750,000 or more in federal awards in a given fiscal year, it must have a single audit. So, just like any governmental body or NFP receiving federal funding, they must undergo a single audit if they expend $750,000 or more. Finally, federal financial assistance. Sponsored research funds. All right, when research grants from federal government are received in the form of contracts by which the government is expecting periodic reports and a report at the end of the grant period as to how the funds were used, then it's important to know whether this research grant has to do with an exchange or non-exchange transaction. In an exchange transaction where the federal government will, for example, retain the intellectual property of the research output or outcome, then there is an exchange for the grant provided. So it could be in the form of testing a product and the like. So if that is the case, then the grant will have to be considered accordingly. The second type of federal financial assistance will come in the form of student grants and loans. Now, student assistance takes various forms. It could be loans or grants, subsidized or unsubsidized, and it's held by the institution or given directly to the student. A Pell Grant is one in which the federal government provides pass-through funds to the institution, which then the institution or the college will then disperse the funds to the recipients based on the federal payment schedules. All right. So in the case of a Pell Grant, it's likely that the institution, if they do not have any authority as to who will receive it, will be considered like a custodian of the fund. Related entities. Public and private colleges and universities can be complex in their organizational structure, including majority-owned subsidiaries for intellectual property or any business-like enterprises. For example, a university might also have a hospital where their medical students will be going to for their training in terms of their medical degree. So the hospital might be considered a business-like enterprise, and clinical research facilities might also be considered another entity. There could even be financing corporations and other controlled affiliates for fundraising, and there might be alumni association and even other entities that will manage the assets of the universities. Now, an important issue is whether there is sufficient control of one organization over another to necessitate the combination of their financial information under one reporting entity. All right. I just wanted to end with this quote from Albert Einstein. Never regard study as a duty, but as an invaluable opportunity to learn, to know the liberating influence of beauty in the realm of the spirit, for your own personal joy and to the profit of the community to which your later work belongs. Albert Einstein, even though he's not a professed Christian, he believes that his work is not fully his own. It actually profits the community. And he says, never regard study as a duty, but an opportunity. I've introduced in the Bible verse earlier in Ecclesiastes 1 verse 13. Hopefully, we will set our heart to seek and to search out wisdom, and hopefully we will not see this more of a burden, but one of personal joy to contribute to the community. This verse that, as you know, Solomon wrote was written at the lowest point of his life when he was feeling so far away from God. And I hope that you don't find the pursuit of knowledge and wisdom as something of a burden, but really as an opportunity to help others that may not be as fortunate as us. And I'll leave you with these words of wisdom, and I will see you in a short while during our class. Bye for now.